We're going to start this morning with one of the most brilliant financial minds that I know, Jeffrey Gundlach, the Bond King, ladies and gentlemen. Jeffrey, thank you for the privilege to visit with you again. How are you?
I'm good, Tony. Good to be here again.
It's great to have you. Well, listen, last time you were with us, the world's changed as it always does so rapidly. One of your recommendations, for example, was gold, and it's up 27%. And then you talked about, people doing crypto, and it's up 58% just this time. But there's a lot of things that have shifted again. And so we'd love to kind of get your worldview. I mean, we're in a place right now, as you know, where the market is highly valued. I think it's 22 times. But there are 7 companies that are 50% of the profits, and they're at 43x. And then you also have a situation where, I don't know how often this has happened, maybe you have more history than I do, but to see we're in a cutting period and interest rates, on mortgages are going up. Can you give us a kind of a big overview of where you see we are in the world and where you see things going with the Fed at this stage as well?
Yeah, I think my most important concept over the past 5 years has been that we had been living in a multi-decade world of falling interest rates. Ronald Reagan came in, interest rates were up at around 14%. Money market rates were up at 20%. And Volcker decided that he was going to, he hiked up all those rates, and he slayed the inflation dragon that had been caused by excessive spending and the like. And so rates fell, and most people's long careers, even me, over 40 years, the great majority of that time period was falling interest rates. And starting about 6 or 8 years ago, I started toying with the notion that you got to be careful of mapping a secularly declining interest rate period into the future past 2020, because probably a lot of things that you think are only occurred in the context of those falling interest rates. And so once interest rates start rising, things will behave a lot differently. And one of those things started to happen because interest rates started rising really in earnest in 2022. And interest rates, I believe, will never go down to where they were back in the 2016 to 2020 period. Those were extremely low interest rates. There were negative real interest rates. And the 10-year Treasury yield was at 0.5%. At one moment, there were $19 trillion of bonds that actually had negative yields. Governments around the globe were able to borrow at negative yields, which to me, I just don't understand why they didn't borrow, $25 quadrillion. Why would anybody pay to lend somebody money? It's just bizarre. So I'll add an epiphany back in July of 2016, because the world was convinced that interest rates at negative levels were normal or sensible, and that they might even stay that way for a very, very long time period. And one day on one of the news wires, I read an article by someone that said, I believe interest rates will never rise in my career, and I intend on having a very long career. And I had this weekly meeting where the senior members of the team come in, and they all seem to have internalized that same viewpoint, that this rate environment was never going to change. And I just felt like a bolt of lightning hit me, and I said, we're going to maximum negative. We're maximum defensiveness, because the one thing that I want to be able to do is, if one day some grandchild comes to me and says, hey, I read somewhere that you were this bond guy, did you buy those negative yielding bonds? And I said, I want to be able to say no. I was never that stupid. And to me, if I were running the Fed, I would not have this army of over 800 PhDs, economists. I wouldn't even set the short-term interest rate. I'd let the bond market do it, because when you really look at it over time, the Federal Reserve simply follows the yield on the 2-year Treasury. It really does. So before they started this cutting cycle, they were miles away from the 2-year Treasury yield, and they really needed to cut to get in sync with the 2-year Treasury yield, and then they finally did. But they've been lagging behind a lot. But the thing that doesn't surprise me is now that they've started cutting rates, and this gets back to the kernel of your question, interest rates have been rising. not falling. This has never happened before in my career. So
Yes.
like I said, this was my theme. What you thought you knew due to 40 years of falling interest rates may not be of any benefit in trying to map a course during a rising interest rate period, which is what I think we're in right now.
Right.
And so as the Fed has cut rates by one full percentage point, starting in September of last year, we've had interest rates on the 10-year Treasury go up by over 100 basis points.
Yeah.
And so this hasn't happened before, but I think this is going to continue. And so the thing that I think is the most important next chapter in all of this is when the economy slows down, we are going to have a crisis in terms of our budget interest expense.
Yes.
Interest expense on our debt is already much higher than it was just 3 years ago. 3 years ago, the annual interest expense on the Treasury debt was $300 billion. Now it's $1.4 trillion. And it's going straight up because the bonds that were all issued back there in 2019 and early 2020, they were yielding 25 basis points, 0.5%, 1% on the 10-year. Well, rates have stopped going up for the time being, but they're still at 4.5% on the 10-year Treasury. There's a lot of bonds that are rolling off that the government's paying a 1% interest rate on, and they're being replaced at 4.5%. And if you think about how that works with all these trillions and trillions of dollars of bonds maturing, we're going to see a significant public discussion about this crisis because we cannot have our present tax system and our present debt management system running simultaneous to each other because we'll end up having all of the tax receipts under the current tax regime going to interest expense. And of course, that cannot possibly happen. So we're going to have to think seriously about how we're going to restructure this debt. And I am not predicting that this will happen, but I'm also open to the idea that it's possible that there could be a restructuring of the Treasury debt to contain interest expense. For example, the Federal Reserve, by the Federal Reserve Act of 1913, is not allowed by law to buy corporate public debt. They're not allowed to, but they did it in 2022.
Yep.
They did it. So don't think that just because something hasn't happened before or that something looks to be prescribed by agreed upon rules, it doesn't mean that doesn't mean it won't happen. So I could easily see our debt be restructured, and that would be very, very bad for some of the people who are lending to us, and it would be very bad for people that don't contemplate the possibility that this might happen. One of the simplest ways of thinking about this is you should own the lowest coupon, the lowest interest rate at issuance date treasuries that you can possibly find. Because if you own the high ones, the ones that were issued years ago at, say, interest rates of 7%, what if they just say, and I'll just make this up as a thought experiment, what if they say every bond that the government has borrowed money using that has an interest rate above X, and I'll just use X as 1%, the interest rate now that we're paying on that is now legally changed to 1%. So that the sevens turn into ones, and the twos turn into ones, and if you're below 1, it'll still stay at the current interest rate. Well, if you own the sevens and you wake up tomorrow morning and they don't pay 7 anymore, they pay 1, you're down about 80% in price that morning, overnight. And this is not even all that hypothetical. This actually sort of happened with the Bank of England a few years back when they had a big interest expense problem and they started issuing boatloads of very long-term debt, even 100-year bonds, and nobody showed up. People said, nuh-uh, you're running, the policies you're running, we're not going to finance them. And they had what's called a failed auction, which means they tried to borrow money and nobody would lend it to them. The interest rate went up about 150 basis points in an hour because nobody wanted them. So these things can happen. So I think it's important to think about these sort of big tail risk events because we're on track with the government management of the debt and the amount that's already there, 36-odd trillion, and growing at 7% of GDP on a deficit basis right now. We were growing at 7% over the last 12 months.
Right.
These are recessionary borrowing numbers. 7% borrowing as a percentage of GDP of a deficit is something that only has happened historically in the middle of significant recessions. And we have positive growth, at least that's what's being reported, and we have a 7% deficit as a percent of GDP. When recessions come, historically, over the long fullness of time, it's about a 4% increase in the budget deficit as a percent of GDP. In the last 3 recessions, it's averaged 9%, skewed very significantly by the COVID experience. But let's just say it goes up by 6%, to pick a number that's somewhere in the middle there. That means we would have a 12%, 13% budget deficit of a percentage of GDP.
Jesus.
That is a crisis. We can't do that. And I think what might happen is the bond market might be thinking about recessions may not mean lower long-term interest rates. They might, at least initially, mean higher long-term interest rates, because people are starting to see the mathematics, the arithmetic of it. It's not a right-wing issue. It's not a left-wing issue. It's an arithmetic issue. Right. That you just take the quantum of debt, you multiply by the interest rate, and that's what you got to pay. And they can only change those laws of arithmetic if they change one of the variables. And in this case, they could change the interest rate. I have some very fundamental guiding principles that I think are non-controversial. The first is don't take any risk unless you're being paid something to take it. How much you should be paid is up for debate, but if you're paying nothing, don't take the risk. Yeah. And then the flip side of that is if you can eliminate a risk at little or no cost, you should eliminate that risk. Yes. And if you do what I'm just talking about, buy the lower interest-paying historical treasuries that are still outstanding, you don't have to pay any cost. They have actually a slightly higher yield, not by much. It has to do with liquidity and how much volume is traded and all this. It's kind of wonky, but you actually get a slightly higher, and I mean slightly higher interest rate. You actually get a small economic benefit, and you eliminate the risk entirely.
Wow.
So that's one of the ways. It's the way you stay in business in the investment industry, I think, is adhering to these principles. That you need to not take risk without being paid, and you've got to eliminate risks when you can do so at low cost. So right now, you talked about valuation in the market. Right now, there's risk all over the place, because you mentioned the PE ratio, the forward PE ratio of the S&P 500, but we like to use the Dr. Shiller's CAPE ratio, which is called CAPE, is cyclically adjusted PE ratio, which really takes a look and analyzes PE ratios relative to about a 20-year history of ranges. And today, the CAPE ratio on the S&P 500 is one of the highest of all times. It's actually at 37. It was only higher one other time, and that was right before the dot-com bust in 1999, and it wasn't very much higher than it is right now. So not only is the stock market very highly valued on a CAPE ratio and PE ratio basis, it's highly valued almost like it was in late 2021 on many metrics: price to sale, price to book. There's about 30 different metrics that are commonly used. And if you put them in percentiles, if one percentile means at the top 1% expensive, we're at that level on many of these indicators, and also maybe third to fifth percentile, so very overvalued. Similarly, we don't have any bargains going on in the credit markets either. In the aftermath of the economy shutting down, there was a short-term collapse in the perception of credit, because everyone was worried that the economy was closing down and companies could go bankrupt and all this. But since then, we've come back to really the lowest compensation ever for buying junk-rated corporate debt versus U.S. Treasuries of the same maturity. It's the narrowest of all time. You're only getting about 2.6% extra. Just a few years ago, you were getting 6% extra, and now you're at about 2.6. So to think that it can go back to 6% is not folly whatsoever. In fact, it's sort of a base case, just a question of when that happens. But we're living in a world where all these valuations are holding, because there hasn't been a catalyst. There hasn't been an event like economic problem of great significance. The inflation problem has been at least forestalled for the time being. We're not at 9%. We're more like at 3% inflation. The Fed wants to get it to 2%. But we've been upgrading and de-risking our strategies pretty much across the board, really for about 18 months, almost systematically. We don't see any catalyst. We just had a meeting yesterday that went on for quite some time, and everybody feels that there's almost no real bargains in the stock market or the fixed income market. And for that, that's the reason that I think that we see commodities starting to move higher. We see gold. You mentioned gold. Gold is the top performer again. 6 short weeks into 2025, gold is outperforming all the standard stock indices with a gain that's up around. It's up about 12 to 17%. I can't remember which it was last time I looked at it, but it's definitely outperforming all the standard stock indices. But this year has been things have been very stable now for about a year, maybe even 18 months, with not a lot of change in valuations after the tremendous volatility in the COVID experience. But I still like gold. I think one thing that's interesting, I think everything changed at the end of 2021. That's when interest rates started rising, and interest rates started to rise, and even with the Fed cutting rates. And one thing that used to be really a very valuable tool was looking at the correlation between gold and the real interest rate on the 10-year Treasury. So the yield, stated yield minus the inflation rate. And they had an incredibly high correlation until the beginning of 2022. And since the beginning of 2022, interest rates are up significantly. Real interest rates are up significantly. That should correlate to a lower gold price, but it isn't. It's correlated to a much higher gold price. So I think a lot of the relationships changed at the end of 2021. And I believe that when the economy weakens, we will see interest rates go up. And this is going to cause a real crisis of debt management.
We were with Ray Dalio yesterday, and he was describing, he said it's a 7.5% deficit projection that we're seeing. And he said his magic number is 3%. If we got to 3%, we can avoid with the death spiral, as you well know. And so we were talking about that, and I was asking him a little bit about it. And one of the questions that I had was, it's 1.3 trillion, and really that's the number he's talking about. So I'm curious, do you think a combination of Doge being able to cut a certain amount? I mean, obviously people are screaming right now because you're taking away their slush fund, but could Doge cut enough of that to get us down to that level? Or Doge and increased productivity through AI? What do you think is there a scenario where we can have a soft landing, or do you see that we're stuck moving in this direction until it gets to be such a crisis?
Yeah, I think we can chip away at the situation, but I don't think you can find enough there. I do think there's more of a restructuring scenario that happens.
So if that restructuring occurs, I might just ask you, what does that do to the reputation of the U.S. and the ability to borrow in the future if we do that? Because that changes the promise. Well, and just one other part of that, timing on this, I'd love to know simultaneously. Ray thinks this is 3 years, give or take a year, before we hit that death spiral where, because of the amount we're paying and the interest rate that we're paying, that we get to the point where it's unsustainable. So what do you think is the timeline? And then I'd love your feedback about that.
I agree that we probably have something like 3 to 5 years would be the window. I think 5 would be the outside,
right?
And three would be shorter, the shorter side of it. But the real problem is that we have these liabilities that are unfunded.
Yes.
And there are $220 trillion of unfunded liabilities, which is about 6.5 times GDP. So you cannot pay these liabilities under the current system. So the simplest thing is to restructure these liabilities. Social Security, a lot of people don't want to talk about that, but FDR put it in place, and they had an eligibility age of 65, and life expectancy on average wasn't even 65. Now, of course, it was depressed, life expectancy was depressed by high infant death, which thankfully isn't such a problem anymore. But, life expectancy got up to nearly 80. It started to fall due to fentanyl and suicides, which are in some cases sort of the same thing. But it's absurd that you would go from a life expectancy of 63 and an eligibility age of 65 to a life expectancy of 79 and an eligibility age of 65. So we need to start actually working on that to make that solution plausible. The problem with the 3% deficit target and the 3% growth target is they're kind of mutually exclusive. I heard Scott Pessin talk about 3-3-3 and 3% deficit, 3% growth. Well, you can't have 3% growth if you cut the deficit from 7% of GDP to 3% of GDP. That would drop the GDP by 4 percentage points. That's not going to happen. It sounds like a nice panacea of putting these things together, but I don't see them as being consistent with each other. And I really think what's going to click off this discussion to be more serious is going to be the rising interest rates at the long end, while economic growth is declining. So we're actually going to have a problem with the interest rates going up while the tax receipts are going down. That's unfortunately the corner into which I think we've painted ourselves. Wow. And the way out is not going to be, I don't think, a massive depression necessarily, but it will be uneven across the economy because you do have to deal with these promises to pay that you never funded. Yes. The government has basically provided the model for a debt-based economy. So we see consumers doing it all the time. I mean, it's almost a badge of honor when you get a credit card. It means that you've made it. I now have a credit card that somebody actually is willing to lend me this money at 23%. Yay! Right? But getting a credit card, I mean, that's not exactly a good thing. We should cut up all our credit cards. But the government is leading by example because they're running on a massive national credit card in essence. And so far, thanks to the dominance of the dollar, which has a lot to do with our ability to run this deficit, I think, thanks to the dominance of the dollar, people have been willing to lend us that money. Now there's plenty of moving parts now in the geopolitical economy with China and Russia and others trying to get a seat at the table of having a say-so in the currency regime, and that could be another problem for our situation because if we don't have the global reserve currency, our interest rates will go higher. That's almost for certain. Our interest rates would go higher. So all of these things are kind of coalescing. They're in a lot of ways they're all the same thing, but different manifestations. It's like we're looking at an object through different facets of a prism, but they all sort of fit together. So I think one of the other things that is defining our era, which is also has a lot of historical precedent, which is not terribly encouraging, is the wealth inequality that exists. You mentioned 7 stocks in the S&P 500 are responsible for a massive amount of the increase. And it's getting to the point where owning the S&P 500 is not diversification. No. Because you have so much of your money in 7 stocks, and many of those are highly correlated to each other. So wealth inequality leads to change. And this is why Ray Dalio is talking about it. I've been talking about this now for 15 years, that we're in a societal transformation, and it's becoming not even a hypothetical anymore as we see all these changes that are happening with, lack of getting along, radical policies, packing the court, and the filibuster, I don't have to follow your laws, I'm not going to follow your laws, nullification, California is nullifying federal law, you're not allowed to do these things, well, we're doing them anyway. Yeah. We're doing them anyway. You cannot deport our people from our sanctuary city. We don't care what your federal law is. Well, that's what started the Civil War. It started as early as 1832, when South Carolina didn't like one of the tax laws, and they said they weren't going to follow it. Well, 30 years later, the Civil War started because they basically said, we're not following your laws. We have states and cities that are doing that not to the same magnitude of severity as, say, South Carolina in the 19th century, but it's a very dangerous situation where people decide that I don't like the way the election went down. I don't like who won. I don't like his policies, and I am choosing not to follow them. That's a very slippery slope, and it's one that we've already embarked on. And so that I think that there's very significant chance of major institutional change in the next 5 years. Fascinating time. I mean, I've dreaded this. I knew this was going to start happening, but at the same time, it's sort of exciting. I mean, I'm actually getting optimistic because as we get closer to this transformation, we're getting closer to a solution.
Yes.
But you know the old canard. To solve a problem, first you got to admit you got one.
Yeah.
And we're starting to admit to ourselves that this is a problem.
Yeah.
And once we can get together on the same page, we can fix it, and we'll fix it with amazing speed. Because once everyone's eyes truly open, they'll say, we cannot keep doing this. We have to change.
Yeah.
Sort of like, like I said, leaving California, there's so much inertia, don't want to do it. And then all of a sudden you have to.
Yeah, necessity is the mother of invention, right? Of what's always been. Unfortunately, we wait till it's necessity. So I just want to circle back from one thing. So you believe the most likely scenario to avoid this death spiral, if we get to a point where obviously it has to change, is the debt restructuring. And you gave the example of the interest rate being dropped. Could it be also lengthening the time before people get their money? But more importantly, what does that do to our ability to borrow in the future when people no longer feel certain? And would that threaten our ability to be the currency for the world?
It might threaten that. It would be obviously very disruptive in the medium term. I mean, obviously you would not be able to look people in the eye and say, you can trust us.
Right.
Of course, what they would do is they would say, this is a one-off. This is a one-off. It's a one-time reset. We promise we'll never do it again. But people would be very skeptical of that. And so in the longer run, it would actually be a positive because it would force fiscal rectitude upon us. No one would lend us money for a couple of generations. Good. We have to have a balanced budget for a couple of generations. How's that for a good idea? Sound fiscal policy. Sound treasury management. That's
Yes.
excellent. I mean, it would lead to a period of a few generations of success, but along the way, it would be a very difficult time period because when you have all these outstanding liabilities, if you're really going to pay them off in today's currency, well, it's just not possible.
Right.
You don't have the buying power. You don't have the assets. The actual assets, financial assets of the United States are actually less than the unfunded liabilities. Think of all the financial assets, $212 trillion of financial assets in the U.S., and our unfunded liabilities are bigger than that. So it's going to be a time of very significant shift, but at least we'll start out with a clean slate and one that we can get back on a path to sustainable, less unequal wealth type of growth.
Well, we're both, I know we both, in 1992, I interviewed the co-authors, one of them's now passed, of The Fourth Turning. I know we both have followed that because that fourth turning shakes everything up, and then there's a new springtime, a new opportunity. And I loved hearing your mindset about it. I share that mindset.
Neil Howe, who wrote that book, The Fourth Turning, put out a new book a year or two ago.
Yes.
And the title is The Fourth Turning is Here.
Yes.
So that's another thing, like Ray Dalio, like the things I'm talking about, like Neil Howe, they're all really the same thing.
Yeah, they really are.
It's an understanding of history and cycles, and that these types of things tend to happen because the political system is at best evolutionary,
Yeah.
whereas innovation and technology are revolutionary. And so new things come and the system isn't capable of handling them because these revolutionary changes cannot be predicted or contemplated. And the wealth that is achieved by these revolutionary changes it kind of plays havoc with the splitting up of the pie. The means of production and the way it's split up get out of sync with each other. And it happens every 3 or 4 generations.
Yeah.
Last time it happened was World War II. The time before that was the Civil War.
Yeah.
And you notice it seems to be every 70, 80 years or so.
Yeah.
And this is it. Add 80 years onto 1945, and you've got 2025.
Yep.
So, hello to that. So that's where we are.
So as you look at the world right now in this environment, what kind of portfolio construction would you think would be useful for investors to protect themselves and take advantage of some of the changes you're describing?
Gold is being purchased by central banks. Gold's being purchased not so much by speculators as it used to be over most of the past decades. It's being purchased as a safety item, as an insurance policy. So, like I said, here we have interest rates going up, real interest rates going up, and yet gold is going up.
Yeah.
That's never happened before.
Yeah.
It's simply because people don't trust the regime. And so gold will continue to do well. I think gemstones, gold, real estate, real assets. I have an unusual economic situation that's not very common, but I have, forget about my ownership of DoubleLine, which I don't even know how to classify that. I just think about if I own securities, financial assets, or real assets, I basically have half of my money in real assets, which is real estate, gemstones, fine assets, and I'm completely comfortable with it. And then I have half of my assets in financial assets. Right now, I think hanging out in short-term, high-quality money market funds. There's nothing wrong with that. You've got a real interest rate. The Fed is not in any hurry to cut rates, and stocks and other things are highly valued. You are absolutely going to get a better entry point on both bonds and publicly traded stocks. Absolutely, you're going to get a better buying point than where you are right now.
Yes.
So meanwhile, you can, and I would have about 20% in cash. So that's out of a portfolio that's $100. I got 50 in real assets, and I would have 20 in cash. That leaves only 30% that would be in stocks and bonds. And I would favor, at this juncture, I'm favoring non-U.S. stocks to U.S. stocks because I don't really, even Europe has started to perform, which is kind of surprising. But I've advocated for quite a few years now, India, for the long term, India stocks, you can buy an ETF called INDA. Sure, it's not going to go up all the time. Yes, there's risks there, but we're talking about a 30-year view, not a 30-day view. 30-year view, because what happened to China must happen to India.
Right.
And they're a tremendous beneficiary of offshoring, of people being less dependent, wanting to be less dependent on Chinese supply chains. So I think you're going to be much better off in India and emerging markets broadly, but I would just use INDA as a placeholder for that.
That's great.
And I would own equal weighted S&P 500, not the official index, which is market value weighted. If you buy market value weighted, you own those 7 stocks, and you have no diversification otherwise. And I think the mega trends have all flipped starting in 2022. Not all at once, but interest rates are not secularly declining at the long end. They're rising. I think equal weighted will outperform market weighted. I think small cap is going to outperform large cap. I think value is going to outperform growth. All of these mega trends that have been in place almost relentlessly, some of them for 20 years, I think they're in the process of reversing, and some of them, to my eye, already have. And so I think the playbook of the secularly declining interest rate environment is not going to be a good roadmap as we move into the future, because the pedestal on which it stood was secularly declining interest rates. That's not with us, at least as far as we can see from here.
Jeffrey, this is so helpful for all of us. You're amazing in your analysis, and you've always been incredibly generous. One quick question we've been asking everyone in the midst of this kind of tough times and perhaps what would be seen as a crisis coming for a lot of people. What gives you joy in the midst of all this? What gives you not just optimism, but joy? What are you enjoying in your life in the midst of, this type of tumultuous change? You've lived through it many times in your life, but what is it for you today?
I am very captivated with watching how this movie ends. I spent a lot of time thinking about these interrelationships of all the things that we've touched upon in our time today. And I got people through the global financial crisis as unscathed as just about anybody in the industry.
Yes, you did.
And this is going to be just as hard, I think.
Yes.
But I want to get myself through it, and I want to get my clients through it. And it's only going to be, I'm 65, and a lot of people say, why aren't you retiring? I want to see this movie end, and I want to get people through it. And the global financial crisis for me, I worked so hard, but it was just invigorating.
Yes.
Because there was real problems to work on, and there were real solutions that if you worked on them hard enough that you could come to. And this is that probably at another order of magnitude. So I look forward to that. I don't wring my hands and distress over where we are, because I'm past that. I'm looking forward to the first turning, which is what's coming next.
Yes.
And you can make the most of that, and it's going to be a period. Trump says the golden age of America. I think he's about 5 years early on that one, but I think he's onto something for the longer term, and I'm excited about that.
This movie ends, a new one begins. Jeffrey Gundlach, give him a hand, everyone. Thank you very much, Jeffrey. You're amazing.